Believe lost almost all its value after legal trouble around its founder blew up the one thing a fragile token cannot lose: trust. The pressure point is simple. Founder legal trouble just turned Believe into a founderess case study. Believe token plummets is the search phrase, but the immediate question is where the next break or failure actually sits. The tension here is simple. The loudest claim is not always the part with the strongest proof. The token reportedly fell about 99% from a May 2025 peak, near 0.3569, to roughly 0.00075 after news that founder Benjamin Pasternak had been indicted on assault charges and faced a court appearance in early June. The chart move is dramatic, but the deeper issue is whether the market underneath it was ever broad enough to support ordinary exits. That gives the story a hard anchor before sentiment starts doing the storytelling. The collapse landed on top of earlier allegations that Pasternak had been involved in a multi-million-dollar rug pull, turning separate legal and reputational problems into one combined pressure event for the project. In easy English, concentrated supply means too much control sits with too few wallets, so price can move without broad demand. This is where structure matters more than surface excitement. For people typing Believe token plummets, the next useful step is to separate what is already operating from what is only being promised. The result was an immediate evaporation of value and trading confidence, with the token becoming an example of how centralized founder risk can break a supposedly decentralized project. That detail is often where the risk moves from theory into actual exposure. The mechanism is single point of failure trust. When a project's identity, treasury confidence, and community story are all tied to one public founder, outside legal trouble can become a market event almost instantly. For traders searching KW, the important distinction is between a bounce created by mechanics and a recovery supported by healthier ownership and liquidity. Once that mechanism is visible, the pricing story gets easier to read. For holders, that means governance structure matters as much as product promises. If the project cannot survive one individual's crisis, then the token may have looked decentralized on paper while still behaving like a founder-dependent startup. When slippage gets extreme, a token can keep showing a price, while many holders can no longer access anything close to that price size for size. This is why users, traders, and treasury desks can react very differently to the same headline. What remains uncertain is whether any operational path exists for the project beyond its founder narrative, and whether outside allegations will lead to further formal action that keeps pressure on the token. The next signal is not a chart level. It is whether governance, development, and treasury control can be shown to operate without the founder, because without that proof, any bounce would sit on very weak ground. The uncertainty is part of the valuation, not a side note after it. That is why Believe token plummets ends with one hard test: whether the next move comes with healthier liquidity and cleaner structure than the last one. When a token breaks this way, the chart is only the surface. The real question is whether the market structure beneath it ever deserved the confidence it was given. Once the noise is stripped away, follow-through is the only thing that can confirm the pitch.